Okay. Hey.
Hey, Lauren. That was fun, wasn't it?
I'm recording it because it was really okay. It would really suck if I wasn't. Okay. All right. Thank you. I really appreciate you taking the time today to discuss everything with me. I know we talked a little bit this morning about some of the changes that are going on in the industry. The first one, I think, because it's immediately affected some of my clients, is the pause on the bank statement loans. Can you go over a little bit of what that means, of like why we can't do banks, like what is a bank statement loan and why we can't do it? And I think it's going to primarily affect a lot of like entrepreneurs and contract workers. Go ahead.
Yeah, no, absolutely. So starting on Friday, we started to see some of the big players in non-QM loan products. And when I say non-QM, I'm talking about stuff that's not your typical Fannie Mae, Freddie Mac government type loan that insures the loans that we're writing. You have products. A very common one these days is bank statements, where you're verifying income using bank statements instead of the tax returns. And what happened started on Friday is a lot of those non-QM products started getting pulled from the shelf. Primelending, we have a lot of correspondent and broker relationships that have been a big part of our business. And companies, just to name a few, like Deep Haven and Angel Oak and Sprout and Caliber and all them, they just, with the way things are going right now, they had to kind of either put business on pause or stop doing those types of loan products. And the main factor is just, these with the mortgage-backed securities kind of tanking, it was harder to move those loans onto the secondary market.
Okay, and so what a lot of people don't know is that kind of what we were discussing this morning was that banks, like you mentioned, banks lend the money, they package the loans, their mortgage loans, and they sell them into the market, right? And a lot of the loans are insured, like your Fannie Mae, your Freddie Mae, they're insured by the government. And the bank statement loans, things like that, aren't insured, right? So it makes it harder for them to sell in the secondary market. And you had mentioned that, and correct me if I'm wrong, because I'm not a lender, so I'm on the other side of the table. When they can't sell it, there's not enough capital there to, like you said, replenish those accounts where they're lending these mortgages from. Is that correct?
Yeah, liquidity just became a huge problem. And, the government stepped in and they've put some money into the mortgage market. But that's really, those funds are really there to kind of make sure that the core business, the Fannie Freddie government loans, can continue to perform. Yeah, with that, honestly, it's got the liquidity to become such a big problem. Without that stimulus, that there could have been a potential big problem with the conforming loans.
Not having enough, basically not having enough pool of money in the market to service the buyers. And then I think we had mentioned this morning that there was a lot of people refinancing right now. Is that going to pose a problem as far as having enough liquidity to service those refinancing?
Yeah, it was the perfect storm, because as the rates, went down at the beginning of March, you had an all-time record demand for refinances, but then you also had all of the money being pulled out of the market, so you had an all-time record low on liquidity. So you can't have, when you have that extreme on both sides, it creates a big problem, and that's why you started to see this impact some of the mortgage companies and banks out there with their credit lines and their own personal assets. So the demand definitely was a big factor in this as well.
Okay, and so we have it kind of the capital is being, I don't want to say, deplenished because there's still, like you said, the government is putting money into these markets in order for there to be enough money to refinance and to lend. But you do have a lot of people in the market that are borrowing right now because of everything that's going on.
Yeah,
And
rates are great.
yeah, the rates are okay. Let's talk about that too, because okay, so the rates had went down like 2%, and everybody was like, "Yay!" If you were already in a home, they were trying to refinance for this rate, and if they were looking in the market, they were like, "Oh, it's time to buy. It's 2%. That's almost free money, right?" And so then they shot up to like over 4%. I mean, what was that about?
Well, I think it was two sides of it. They almost got to 5 again, if you really want to know the truth.
Mm-hmm.
And I don't know that I've ever seen such a sudden and drastic change.
Yeah.
You don't typically see those types of movements for, over a full 12 months, much less, days and barely a week. Yeah. So it's kind of two sides of it. I'll try to be short. I have trouble with, being short sometimes. I'm into the details, but basically, I think initially the mortgage industry had to push back. The demand became so great for refinance. When rates got that low, there just wasn't enough people like myself, mortgage lenders. There wasn't enough processors, underwriters. We were way over capacity. We're talking about almost 8 times the normal production levels that we were on pace to produce, and not many industries can handle that type of growth overnight. So I think initially it was a kind of a pushback. They called it throttling, just to kind of slow the business down.
Yeah.
And then what happened is the market just got so far out of whack that I think the really smart people that set these prices and understand the back end, the secondary markets, and the stock market way better than I do. They got to a position where it became really risky to bring the rates back down, because they were seeing spreads in the yield and in the just stock market and Feds and U.S. Treasury and unemployment. There was just, the numbers were so far all over the place. I think they kind of had to just slow things down and wait and see how all of this played itself out. You can't afford to take those types of risks and lower the rates back down without a full grasp of what's going on.
Yeah. But I also saw this week where the rates were back to where they normally have been, like around the range they have been in the past 6 months, which is between your 3.5 and your 4. Is that them trying to kind of stabilize, or trying to just be like, okay, we like you said, throttled it. We slowed down the number of applicants by increasing the rate. That way we're not jammed in the industry, but we also, now we're trying to like not shock us into like 2% raises. Is that why we're back down to 3.5, like 4%?
Well, the stock market has put together a couple of good days in a row, so that I think it kind of starts there. The mortgage-backed securities have performed better this week, so I think the rates actually could be lower than where they're at right now when you look at some of the other metrics like the U.S. Treasury and so forth. But seeing having a better picture of what the stimulus plan is going to look like has kind of instilled some consumer confidence, which has brought the rates back down to pretty much where we were before all of this started. And the rates were actually really good before this became so public. It's just we didn't really have a very captive audience. The consumers weren't. They maybe heard that rates were low, but it wasn't like their number one priority. But it became a very popular thing, and now that they're back kind of down where they were before, it's a great opportunity for a lot of people. Where they go next is a good question. Will they go back to where they were at the beginning of March? They could. I don't know that the industry wants to do that overnight again. So we may see a little bit slower pace from this point on, but they could get better. But then again, we don't know. They went up super quick last time around, and I think if it makes sense to refinance today, it's probably best to just go ahead and get that rate locked in, because if they go the wrong direction, there's nothing loan officers like us can do to save you.
Okay. And then, so that's where that goes into the next question. So they did come back down, which is kind of like, ooh, okay, I'm not, particularly people who were already under contract and they hadn't locked their rate in, and to see it shoot, you put a contract on a house, or you started a refinance and thinking it's going to be this rate, and then all of a sudden it increased almost 2 points. So if somebody wants to lock now, right, on average, is there an industry standard on how long that lock is good for, or what do they need to do in order to lock the rate at it's still very low right now?
Yeah, so let's start with purchase. So the majority of our business is purchase. About 90% of my business is traditionally helping people buy homes. And I know that's really what you do as well,
Yeah.
Working for K of Nanny, and you're helping buyers. So with that, it really, how long the lock is good for really is case by case. And we base that on a resale. We base that on the contract. Is it a 3-week close? Is it a 45-day close? Is it a 2-month close? We're going to lock it according to the contract. Now, what we face in these types of volatile markets is people are afraid that if they get a contract today and they lock in today, what happens if the rates go down more?
Yeah.
Primelending, we do offer a free float down. We can actually float a rate down up to 0.3%. There's a few rules that go with that, but it gives people the peace of mind that they can lower that. They can lock in now, not have to worry about the rate going up. So they protect themselves. And then there's an opportunity to revisit the market before closing to maybe take advantage of lower rates if they're available. Now, on a refinance, we're pretty much locking everything at 90 days. And it doesn't necessarily take us 90 days to close it, but we're trying to set the right expectation up front. And we don't want to risk locking it on 30 days and then with capacity, still being a problem.
Yeah.
That rate expiring. So we're locking for 90 days, and we still put that float down on the refinances as well. So they'll still have that same option.
Okay. And then I know we have mentioned before, I was saying because of the capacity issue, because of so many people entering the market, both purchasing and the refinance, and then what's going on with people's jobs being suspended, or like we have mentioned hourly workers. One of the questions I had was, is it going to be a lot harder for people to qualify? And you said something, to the opposite of that.
Well, I guess you could look at it as opposite. I look at this as, how we always look at fluctuation in pay. If we have somebody that's had stable pay all the way up until an event in their life, or in this case, a global event, and then income resumes the normal pay structure, then usually a good explanation that can be proven, an underwriter is going to be okay with that period where it was a little bit off. If you have somebody that's had very volatile, unstable income before, it's going to be tough to get around that just because of what we're all dealing with now. So I think it really is kind of case by case on how we're going to look at either no pay or reduced pay during this time frame. I think you're just going to have to really talk to your loan officer and let them advise you on that particular case. As far as guidelines on how the underwriters are going to look at income in this particular situation, there hasn't been a specific rule that's changed, or we haven't been informed of any set changes and guidelines that are coming, but these things can change from one day to the next.
Okay.
But I think the biggest thing right now is just talk to your loan officer about this, because they're going to understand your personal situation better than anyone else after you discuss it with them, and then just trust their guidance on that.
And then I know that you were saying, like, if you were in the process of purchasing a home or refinancing and your hours got cut or your salary has been affected, to document just that change within this time frame. like, what do you mean document? Like, are there specific things they would need to provide for an underwriter in order to like
If
show?
possible, yeah, if possible, you know, a letter from the employer with an explanation. You know, that could help. I had somebody just yesterday that she got notification from her employer that hours are going to be cut, and this person consistently worked 40 hours a week. And I said, hey, look, I can't, you know, it wouldn't hurt if you got that in writing.
Okay.
You know, those types of things. You know, a lot of times in underwriters are put in a position where they have to make, you know, judgment decisions, discretionary. And when you have documented proof on what took place, then typically it's something that you can work around.
Okay. And then I did have someone that wrote in I told people to message me. So I did have somebody who had a question, and it was about the refinance. So let me pull that one. My mother had a question too. One of the questions she had was about people who had equity lines of credit. Are we seeing equity lines of credit, which is different than a refinance? Equity lines of credit is a kind of a loan on the equity of your house versus refinancing and rolling it into your mortgage. Are we going to see a pause on people our banks doing equity lines of credit like we see on bank statement loans?
No, actually. So first off, we do not offer home equity lines of credit here at Primelending, acronym HELOCs. So people, I actually would think that HELOCs could maybe become pretty popular because with the Fed rate being nearly zero, you know, that is really, so when the Fed rate dropped, everybody was like, hey, how low are mortgage rates going to go? And the Fed rate does not directly impact mortgage rates, but what it does affect is the shorter term loans like credit cards and HELOCs. So, I mean, you could, if you're just looking for some sort of a second line of credit on your house, I mean, those could be attractive actually going forward. I mean, it's not going to help you lower your rate on your first mortgage, but
it didn't help you because a lot of people may be looking to get some of the equity or liquidate some of the equity in their home in order to get them through this time because their pay has been cut or they're not working like they were. So in cases like that, when the Feds drop the rates to zero, does that mean people can borrow for zero? Or
it all depends on their equity position on their house. So in Texas, you're limited to 80% of the value of your home. So if you do have enough equity on your home, then you could tap into that. So I think for somebody, just to kind of give a general example, if somebody had a $200,000 house and they owed $100,000 on it, you know, you could lend up to $160,000 on that home. So that would mean they have roughly $60,000 in lendable equity. If they have, let's say, a 3.5% on that $100,000 mortgage, first mortgage, then I think a HELOC would probably be a decent option to tap into that $60,000 of lendable equity. Now, if they have a 4.5% on their first mortgage of $100,000, it might make sense to just tap into that equity and do a first mortgage Texas cash out. That way they could get the low rate on both the refinance of the first mortgage balance and also get the cash out they were wanting. So that's another case by case. You just, you know, take a look, call your loan officer and tell them what your numbers are and then go from there.
And then, okay, so one of the borrowers, they wanted to know they're a homeowner, but they also have a secondary rental property that they may be refinancing their investment property. Should we expect higher rates for the refinance of an investment property, or is it the same? Would you still be able to stay with the market rate for those?
Yeah, so investment rates are mortgages on investment properties are always going to be higher. It's a non-owner occupied property, which is considered a little bit higher risk. We do take better care of our own stuff than we do other people's stuff. So the collateral, you know, you're going to get better rates on a primary residence than on an investment. Now, I am seeing some investors jump in on this market because typically mortgages on investment properties have always been in the 5s and even 6% range. So if you can refinance that investment property that's at 5 or 6 and get it into the 4s, then that may make sense, right?
Yeah.
So I am seeing some investors take advantage of that.
But if you have similar rates between your homestead and your investment properties, similar equity into the both, and you're trying to figure out which one to refinance,
Which one to tap in?
you probably should refinance into your homestead versus your investment if you were looking for the better rate.
I think it depends. I think one of the first things you got to look at is how much equity do you have in the investment property. You're limited, instead of 80% on a primary residence, you're limited to 75%.
I did not know that. Okay.
Yeah. So I think it's going to start with how much cash equity do you have, lendable equity do you have in the property. If that's your primary goal, is to tap into the equity and get an influx of cash, then it really is going to start with your equity position on that property. If your motivation is just a lower rate, then you know, you can go, you know, then it's just a matter of looking at your current balance and rate and then refinancing the balance.
You were saying that earlier in our earlier conversation, you had mentioned about people refinancing. Is it worth it, right? So we're maybe at like 3.5 right now, and let's say somebody has a 4.5. In your opinion, is it worth the refinance to drop at that point? I know that's thousands of dollars over the life of the loan. I mean, when should people who are monitoring the market say, okay, this is the time to either purchase, you know, or this is the time I need to refinance if I'm at a 4.5?
Yeah, I think if you're looking at lowering your rate 0.75% or more, you should have the conversation. You know, Lauren, I think, you know, you'll notice a theme in a lot of my answers, and it's really case by case. And I think that's why having a loan officer that you feel like you can trust to give you the right advice is so important. There's a lot of online lenders out there that are just going to try and, you know, they know they have a captive audience and they're just going to try and throw a low rate at them, and not really help that consumer understand, you know, what their options are, help them understand what their goals are. Because there's so many different factors. I mean, we're talking about, yes, the starting point is how much am I going to lower my rate? But, you know, you also look, there's a lot of people that didn't put 20% down on their house, so they could have mortgage insurance. Could they potentially refinance their house and either get rid of mortgage insurance altogether, or maybe at least reduce how much they're paying per month in mortgage insurance? So sometimes you could lower somebody's rate 0.25%, but if their equity position in their home has changed and now they can refinance at 80% whenever they bought at 95% loan to value, then that MI portion of their payment may either go away entirely or be reduced by hundreds of dollars. So sometimes it's not only about the rate. You also look at some customers, you know, a lot of people are making more now than they were making when they bought the house. So could they afford to pay a little bit more and, you know, and go to a 15-year? You know, when you look at the overall long-term savings on a 15-year note, sometimes paying, you know, $300, $400, $500, $600 more a month can save you hundreds of thousands of dollars over the life of the loan. So there's so many different ways to look at it. I think, you know, if you're interested in looking into these options, it starts with a phone call. You know, talk to your loan officer, get them your information. Normally you can just send them a copy of your mortgage statement, have a 15-minute conversation with them about your goals, and the loan officer can put those estimates together. And I think it's real important, if you are interested, is to do that sooner rather than later, because what's happening, as we talked about in the beginning of this call, is the rates are so volatile that the windows sometimes can be very small. And if you haven't gone through that exploratory phase already with your loan officer, you may not have time to really do that the next time that window with the super low rate comes around.
Okay.
And with the demand being so high, you know, a lot of loan officers are only able to get to the ones that were already ready. You know,
Yeah,
the
are
legwork
already
has
in the
already been done.
process. So that's another question. So let's say somebody's looking in the market, they want to purchase a home. And like you said, the rates are volatile. Can they lock a loan without being under contract? Or they have to be under contract in order to lock a
No,
loan?
that's going to be different for every lender. We do offer a lock and shop, is what we call it.
Hey, lock and shop. Okay, I like that.
You know, I've done a couple of them. There are some extra fees up front that may or may not make it attractive. But you know, if you're in a record low
Like
rate
2%,
climate,
like we were at the beginning of
yeah,
it may be worth it.
That may be worth looking at. Yeah.
The lock and shop. Okay. And then for people, what would you say to the buyer who sees these rates kind of being all over the place and is getting nervous and is just like, you know what, I'm going to throw my hands up. I'm not going to do this. Like, you know, what would you say? Like, would you say it's still a healthy market to still move forward? Or do you, I mean,
Yeah, it's probably the easiest question you've asked me. Yeah, you really can't be that short-sighted, and I hope that doesn't offend anybody. But in December of 2018, the going rate was like 5%. So if you're frustrated that the 3.5 that was available yesterday is now 4.25, get over it pretty quickly, because 4.25 is still pretty darn good. It may not be as good as what it was, you know, 3.5, but it's still a really good, and it's still a historically low rate. So I think if somebody has already decided to make a home purchase or make a move, I would hope that a low or mid 4% range rate wouldn't
not be a deterrent.
Change their mind. Yeah.
So then one of the things I hear people saying, and I saw this, somebody had posted where they were about to go to the closing table and completely backed out. I know a lot of people are worried about their job security because people are thinking about the ripple effects of just maybe even, let's say everybody went back to work tomorrow. There's ripple effects that we can't even see that are going to be 6 months from now. Now, I read that, you know, Trump had suspended for mortgage foreclosures temporarily while this is going on, while people are trying to figure out what's going on in the economy, people trying to stabilize their jobs. I mean, what would you tell people who are not even so much worried about the interest rates, but worried about job security and the affordability of a home, you know, 6 months from now?
Yeah, you know, and again, that's another case by case, because Houston is such a diverse economy. You know, there's some industries that are thriving in this market, and there's some that are crumbling. So I think that's going to be an individual decision on how they how confident they feel moving forward purchasing a home.
Okay.
Because there definitely are a lot of people out there that are being seriously impacted by this. You know, and we're talking about financially right now, of course, because this is what this call's about. But you know, that's really unfortunate that some businesses are having to close, and some people are being laid off, and then there's, you know, could be more coming. So that's really going to be more of a personal confidence question.
Okay.
As a economy, Houston, I tell people this all the time, and I think everybody already knows this, is we seem to come out of these things quicker than the rest of the country because we are so diverse.
Yeah.
So I feel confident about Houston's overall market.
Yeah.
Only because it's how it's always reacted in the past.
Okay. Let me see if there was, we addressed going from a 30-year to a 15-year fixed right now. So we discussed that may be to refinance to a lower rate, but also to maybe refinance at a lower rate at a 15 versus a 30. I think that's it. I mean, I don't know. Can you think of anything else that people need to know?
Well, like always, Lauren, you're pretty thorough, and I think you covered a lot of ground today. You and I've been working together now for almost 6 years, huh?
Yeah, we've been working for a minute. So, okay, so I think that is it. Of course, if I have any questions, I will reach out to you personally as a sales professional in the industry. And then if anyone else has any other questions, I can give them your contact number that will be posted in the.
Absolutely, yeah. I'm on Facebook Messenger, so if anybody does want to chime in, feel free to share that info. You're welcome to share my email address and cell phone, whatever.
I did have one more question. For somebody who's struggling to pay their mortgage right now because of everything that's going on, do you know of any recourses, or do you know of anything like government stimulus that's going on to help people with that right now?
I think that's very close to being finalized. In fact, it could be, and maybe I'm a little behind on that news, but last I heard, there were some banks that were making personal rules, like on how to handle those situations. But I think overall, Fannie and Freddie and those types of investors are putting some parameters in place on how to qualify for some sort of a deferment for a few months, where those payments do need to be made, but they don't accrue interest. They don't continue to accrue interest on those unpaid balances. So the relief is going to be there. It's not, from what I've understood, it's not going to be everybody can just skip their mortgage payment. I think you are going to have to prove that you were impacted and experience some reduction in income.
Now, what I've heard people say is that then I'm going to be finished, I promise. That what I have heard people say is during the kind of the last recession or hardship, they were able to get a deferment, but then it was like a balloon of all. So if they were able to skip 3 payments, and all of a sudden all 3 payments are due at one time. Is that what we're seeing? Or
what I've read is it sounds like they're trying to do this the right way, where they're just going to be added to the back of your loan, but those payments, that normal principal reduction is not going to just sit there and continue to accrue interest. So if it did, then it would completely change your amortization schedule. And my understanding is they're not going to do that. I think they're still working on that plan, though.
Okay. All righty. Well, I hope that was some good news for people. I'm sorry about the Facebook glitch, and I'll have this posted here momentarily. Thank you, Chris. Thank you so much. I really appreciate it.
Thank you, Lauren. Bye-bye.
All right, bye. All right, let me